What's up, everyone? Marcus here with your not so weekly tax tip. So, nothing in life is certain except death and taxes. And today we're talking about when those two certainties collide, the estate tax. Now, most taxpayers completely ignore estate taxes, thinking that they'll never be affected. Unfortunately, that's an assumption that could cost your family big time. Now, why is that though? Because these tax rules are constantly changing. So, let's break down this concept of estate tax by the most common questions that I receive. So, first up, who actually pays estate taxes? Well, technically, the tax is levied against the estate of the person who passed away. But in reality, it's the surviving family members who feel the impact because it directly reduces their inheritance. Next question. What counts in your taxable estate? Well, pretty much everything you own at the time of your death. Your house, your vehicles, your furniture, that vintage baseball card collection that you've been holding on to since childhood. As a matter of fact, I had an aunt who was convinced that her Beanie Baby collection would fund her retirement. Of course, 30 years later, those rare collectibles are worth less than what she paid for them, but they still would count towards her taxable estate. Your estate also includes all of your investments, stocks, bonds, mutual funds, real estate holdings, bank accounts, and retirement accounts. The total taxable estate is the value of these assets minus any deductible expenses and debts. So, say you got a $2 million house, but you still owe $1 million on the mortgage. Only the $1 million in equity counts towards your estate value. Which brings me to my next question. How are assets valued for estate tax purposes? Well, it's generally, they're determined at fair market value on the date of death. I'll give you an example. So say your grandmother paid $10,000 for a painting by a local artist 30 years ago. If that artist became famous and the painting is worth $25,000 when your grandmother passes away, the estate value is $25,000. Now, asset valuation can get complicated quickly, especially when we're talking about unique items like art, collectibles, or private business interest. But now for the big question. How is the estate tax calculated? Now, for federal tax purposes, it is 40% of assets in excess of the federal exemption amount, a 40% tax. Now, that exemption that you get is about $14 million per person. It sounds like a lot because it is. However, that exemption is scheduled to decrease to approximately $5 million adjusted for inflation after this year. If you're married, you get to double that. So you get up to a $28 million federal estate tax exemption in 2025. Now remember, just like I said, this amount is scheduled to dramatically reduce by the end of the year. So don't get too comfortable. Okay, moving on. So let's clear up a common source of confusion. All right. So what's the difference between an inheritance tax and an estate tax? So an estate tax is paid by the estate before assets are distributed to the beneficiaries. An inheritance tax, on the other hand, is paid by the individuals who receive money or assets from the estate. Now, the federal government, they do not impose an inheritance tax, but 6 states currently do. That's Iowa, New Jersey, Pennsylvania, Nebraska, Maryland, and yes, Kentucky. By the way, if you live in Iowa, they're going to phase that out by the end of 2026. Good news for you. Speaking of states, what about estate taxes at the state level? Well, currently 12 states plus the District of Columbia, they have their own estate taxes with exemption amounts varying significantly from state to state. Some states have their exemption amount as low as $1 million. Seemed like a lot in 1997, but today $1 million can be a house in an urban area. So location matters tremendously in estate planning. All right, so let's talk about gifts, right? How are gifts to others handled in relation to estate taxes? Now, when you give a gift to someone, the federal government generally doesn't care until the value of all gifts to one person in a given year exceeds the annual exclusion amount, which is $19,000 this year, 2025. So if you want to give your nephew $18,999 to help with college tuition, no reporting required. You give him $19,001, you need to report that extra $1 to the IRS. Now, this is particularly important to understand if you're helping family members with major expenses like education, let's say a wedding, or down payment on a house. But with some careful planning, you can maximize giving without triggering these tax consequences. Now, what I just went over, does this cover everything about estate taxes? No, it doesn't. Estate planning, it can get complex, especially if you own a business, if you have a blended family, or if you have other special circumstances. But hopefully, by understanding some of these basics, you now have a better idea of when you might need professional help. But don't wait until it's too late. Remember, estate planning is not just for the ultra wealthy. It's for anyone who cares about what happens to their assets and their loved ones after they're gone. And as always, if you have any questions, please reach out to us. Until next time.